Today, we're diving into a hot topic that's got everyone talking: the potential for economic crises and the fragility of stock markets. With so much happening in the world, it's crucial to understand what's going on with our economy and how it might impact our financial future. Let's start by looking at the current economic situation. Right now, inflation rates are climbing in many parts of the world. This means that the cost of goods and services is going up. Why? Well, supply chains are messed up, and energy prices are through the roof. To control this, central banks are tightening their belts, which means higher interest rates. This makes borrowing money more expensive and can slow down economic growth. Inflation is essentially the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. For instance, when inflation rises, central banks like the Federal Reserve in the United States often increase interest rates to cool down the economy. This strategy can help reduce the amount of money circulating in the economy, thereby reducing spending and slowing down inflation. However, this approach also has the downside of potentially stifling economic growth. But that's not all. Geopolitical tensions like trade disputes and conflicts are adding more uncertainty to the mix. These issues can shake up markets and make investors nervous. When investors get worried, stock prices can swing wildly, affecting everything from your savings to your investments. Geopolitical tensions can stem from various sources such as international trade disputes, military conflicts, or even political instability within a country. For example, trade disputes between major economies like the United States and China can lead to tariffs and other trade barriers. These actions can disrupt supply chains, increase costs for businesses and consumers, and ultimately lead to slower economic growth. Additionally, military conflicts or political instability in key regions can cause oil prices to spike, further contributing to inflation and economic uncertainty. It's important to remember that stock markets don't operate in a vacuum. They are deeply connected to what's happening around the world. A crisis in one country can send shockwaves across the globe, making financial markets unpredictable. That's why it's crucial for everyone, not just the experts, to keep an eye on these market dynamics. The interconnectedness of global economies means that events in one part of the world can have a ripple effect on other regions. For example, a financial crisis in a major economy like the United States can lead to a global recession, as other countries' economies are affected by reduced trade and investment. Similarly, economic troubles in Europe or Asia can impact markets worldwide, leading to volatility and uncertainty. Understanding these interconnections helps investors and policymakers better navigate the complexities of the global financial system. Now, let's talk about the impact of geopolitical events. Elections, international agreements, and conflicts can all sway investor sentiment and market trends. By staying informed about these factors, you can better prepare for potential market shifts and make smarter financial decisions. Elections can significantly impact financial markets, as changes in government policies can affect economic growth, regulation, and trade. For instance, a government that prioritizes fiscal stimulus and infrastructure spending might boost economic growth, while a government focused on reducing deficits and cutting spending might lead to slower growth. International agreements such as trade deals or climate accords can also influence markets by altering trade patterns, regulatory environments, and investment flows. Conflicts, both military and economic, can create uncertainty and volatility in financial markets. Military conflicts can disrupt trade routes, increase oil prices, and lead to broader economic instability. Economic conflicts, such as trade wars, can lead to tariffs and other trade barriers that disrupt global supply chains and increase costs for businesses and consumers. Staying informed about these geopolitical events helps investors anticipate market shifts and make more informed decisions. As we navigate these uncertain times, it's essential to approach your financial strategies with caution and foresight. The economy can change rapidly, so having a good grasp of the factors driving market movements is more important than ever. We'll discuss ways to reduce risks and adapt to changing market conditions, highlighting the importance of diversification and long-term planning. Diversification is a crucial strategy for managing risk in an uncertain economic environment. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce the impact of any single market event on their overall portfolio. For example, Investing in a mix of stocks, bonds, real estate, and commodities can help mitigate the impact of a downturn in any one asset class. Long-term planning is also essential for navigating economic uncertainty. By focusing on long-term financial goals, such as retirement savings or funding a child's education, investors can avoid making impulsive decisions based on short-term market fluctuations. A well-thought-out financial plan that includes regular savings, disciplined investing, and periodic portfolio reviews can help investors stay on track even during volatile times. Let's take a historical example: Japan's economic crisis in the early 1990s. During the late 1980s, Japan's economy boomed with sky-high real estate and stock prices. But this bubble burst, leading to a decade of economic stagnation. The lessons from Japan's crisis are still relevant today, showing the dangers of unchecked speculation and a fragile economic foundation. The Japanese economic bubble of the 1980s was characterized by excessive speculation in real estate and stocks, fueled by easy credit and lax regulation. This speculative frenzy led to a rapid increase in asset prices, creating a bubble that eventually burst in the early 1990s. The aftermath, known as the Lost Decade, saw a prolonged period of economic stagnation, deflation, and financial instability. The Japanese experience highlights the risks of speculative bubbles and the importance of maintaining a stable and sustainable economic foundation. Fast forward to today, and we see some parallels in the U.S. market. Stock prices have soared, driven by low interest rates and a surge in retail investing. While this growth is celebrated, it also raises concerns about sustainability. There are signs of speculative behavior, especially in tech stocks and meme stocks, similar to what Japan experienced. Plus, rising inflation, supply chain issues, and geopolitical tensions add to market volatility. In recent years, U.S. stock markets have experienced significant growth, driven by factors such as low interest rates, fiscal stimulus, and increased participation by retail investors. However, this rapid growth has also led to concerns about overvaluation and speculative behavior. For instance, the rise of meme stocks, driven by social media hype rather than fundamental value, has raised questions about market stability. Additionally, rising inflation and supply chain disruptions are contributing to market uncertainty, echoing some of the conditions that preceded Japan's economic crisis. One key concept here is the carry trade, borrowing money at low interest rates to invest in higher-yielding assets. This can boost returns during good times but creates vulnerabilities if the market turns. If asset prices fall, those who borrowed might have to sell their investments quickly, causing a market cascade. The carry trade involves borrowing money at low interest rates, often in one currency, and investing it in higher-yielding assets such as stocks, bonds, or real estate in another currency. This strategy can be profitable during periods of low volatility and rising asset prices. However, it also creates risks, as sudden changes in market conditions can lead to rapid unwinding of these trades. If asset prices decline, investors may be forced to sell their positions to cover their borrowing costs, leading to a cascading effect that can exacerbate market downturns. In this complex landscape, vigilance is crucial. Understanding the risks of carry trades and market stability helps investors prepare for potential shifts. Remember, lessons from Japan's crisis can guide us in today's market. Consumer behavior is another crucial factor. As prices rise, people may cut back on spending, affecting businesses' revenues and stock prices. Lower consumer confidence can create a feedback loop, amplifying market volatility. Consumer behavior plays a critical role in the economy, as consumer spending accounts for a significant portion of economic activity. When prices rise, consumers may become more cautious with their spending, prioritizing essential goods and services over discretionary purchases. This shift in behavior can impact businesses' revenues and stock prices, particularly in sectors like retail, hospitality, and entertainment. Additionally, lower consumer confidence can create a feedback loop where reduced spending leads to lower business earnings and further declines in consumer sentiment. Business performance also matters. While many companies reported strong earnings recently, supply chain disruptions, labor shortages, and rising costs could slow growth. If businesses struggle, it could lead to lower earnings and impact stock prices. The performance of businesses is a key indicator of economic health. Many companies have reported strong earnings in recent quarters, benefiting from the economic recovery following the pandemic. However, ongoing supply chain disruptions, labor shortages, and rising input costs present significant challenges. If businesses are unable to meet demand or face increased operational costs, it could lead to lower earnings and impact stock prices. For example, a company facing higher costs for raw materials and shipping may see reduced profitability, leading to downward revisions in earnings forecasts and potential stock price declines. Experts have mixed views on recession risks. Some warn that rising rates and inflation could slow the economy, while others believe the economy is resilient. Regardless, it's wise to stay informed and prepared for potential downturns. Economic experts have varying opinions on the likelihood of a recession in the near future. Some argue that rising interest rates and inflationary pressures could slow economic growth, potentially leading to a recession. They caution that while controlling inflation is essential, aggressive rate hikes could stifle consumer spending and business investment, leading to adverse consequences for the overall economy. On the other hand, some experts believe that the economy is resilient enough to withstand gradual interest rate increases without falling into recession. They point to strong labor markets, robust consumer spending, and healthy business finances as indicators of continued growth. Regardless of these differing views, staying informed and prepared for potential downturns is crucial for investors. Let's discuss the Federal Reserve's role. The Fed uses tools like interest rate changes to manage the economy. In past crises, it lowered rates to stimulate growth. Today, with inflation rising, the Fed may raise rates, impacting borrowing costs and economic growth. The Federal Reserve, as the central bank of the United States, plays a crucial role in managing the economy through monetary policy. One of the primary tools the Fed uses is adjusting interest rates. During past economic crises, such as the 2008 financial crisis, the Fed lowered interest rates to near zero levels to stimulate economic activity and restore confidence in the financial system. This approach helped lower borrowing costs, encourage consumer spending, and support business investment. In response to the COVID-19 pandemic, the Fed also implemented aggressive monetary policies, including lowering interest rates and purchasing large amounts of government and mortgage-backed securities. These measures provided liquidity to financial markets and ensured that credit remained accessible to households and businesses. However, with inflation rising, the Fed is now signaling a shift towards tightening monetary policy. This may involve raising interest rates to control inflation, which could impact borrowing costs and economic growth. Higher interest rates can lead to increased mortgage rates, higher costs for business loans, and reduced consumer spending, all of which can slow economic activity. Higher rates can affect sectors like housing, where mortgage costs rise, slowing home sales. Industries that rely on borrowing may also see reduced profitability. Experts predict varied outcomes, highlighting the importance of monitoring the Fed's actions. Higher interest rates can have significant effects on various sectors of the economy. In the housing market, for example, higher mortgage rates can make home purchases less affordable, leading to a slowdown in home sales and construction activity. This can impact not only the real estate industry, but also related sectors like home building, materials, and consumer goods. Industries that rely heavily on borrowing, such as consumer discretionary and capital-intensive sectors, may also see reduced profitability as financing costs increase. For instance, companies in the automotive or manufacturing sectors that depend on loans for capital investments may face higher costs, potentially leading to reduced expansion and slower growth. Experts predict varied outcomes for the economy, reflecting the uncertainty surrounding the Fed's potential actions and their implications. Some economists argue that the Fed's tightening measures could lead to a more pronounced slowdown in economic growth, potentially tipping the economy into a recession. Others believe that the economy is resilient enough to withstand gradual interest rate increases without significant adverse effects. To wrap up, we've covered the factors contributing to market fragility, including inflation, geopolitical tensions, and interest rate changes. We also discussed the impact of earnings reports and geopolitical events on market sentiment. Understanding these dynamics helps navigate the economic landscape. Stay informed and proactive in your investment strategies. Subscribe to Success Dude for more insights and updates on market trends and economic developments. Share this video with others and join our community in the comments below. Your engagement helps us provide valuable content to navigate these uncertain times together.